there's talk, Jim, of the U.S. dollar of losing the status as world reserve currency. Have you? What do you have?
Oh yeah, I hear that. Yeah, you're right, Kim. I hear that all the time. I get asked that all the time. It used to go under the name of the Great Reset. It was like the Great Reset was going to be, we'll have a new Bretton Woods and we'll reset the international monetary system. The dollar won't be the leading reserve currency. Kind of begs the question, well, what is? Is it going to be the SDR? Maybe. Is it going to be a digital SDR? Yeah. Okay. A digital SDR backed by gold? Well, that could work, but nobody wants gold except me and a few other people. So that's the Great Reset. What's interesting is that our friend Klaus Schwab, who is the head of the global elites, he's their chairman, runs the Davos conference, of course, came out with a book called The Great Reset. But they hijacked the term. They hijacked it as basically the new world order. So now when you say the Great Reset, you've got to define your terms, because there's a lot of gold supporters, people worry about the dollar, hey, we're going to have a great reset. But then you got Klaus Schwab, Jamie Dimon talking about the Great Reset, meaning get back to globalization, get back to the new world order, break down borders, and maybe get away from the dollar, but not in favor of gold, in favor of something controlled by the IMF. So that's in the air. I don't see it happening. See, here's the thing. You're never going to have a world where people lose confidence in the dollar, where they say, hey, get me those euros or get me those yens. All these currencies are going to go down together. They may stay up together. People may have confidence in them. But if they collapse, they're all going to collapse. The idea that I hate the dollar, but I'll take all the euros you get. No, that's not going to happen. You think Europe's going to be better off than the United States in a world where confidence in the dollar is collapsing? That's going to be a world where confidence in everything is collapsing. Now, that's a world where everyone goes straight to gold. However, some people are going to go straight to Bitcoin, or they already have. So I don't think gold and Bitcoin are comparable. And I've been in more gold Bitcoin debates than I hate them all, but I get invited. I'm always asked to join them, and I do. I actually was that cut man for Frank Gesture when Frank did a gold Bitcoin debate with Michael Saylor. Michael Saylor has made $5 billion in Bitcoin. So it's real money. I mean, he hasn't sold it, but on a mark-to-market basis, he bought it at 19 and went to 60, and he bought like $2 billion, and you triple something, he's up to $6 billion. And Frank is the greatest gold mining financier of, since, probably George Hurst. So here you had your gold guy and your Bitcoin guy. So I kind of coached Frank from the sidelines, and we did a couple prep calls and all that. Frank did a great job in the debate. But you can't, whatever I think of Bitcoin is irrelevant, because you can't dismiss it. It's out there. So I think what I would expect is something possibly chaotic and a real roller coaster. And that's a world where you definitely want gold.
Again, would you go back into why we have three Feds? There have been three Feds. The greatest prosperity was between the second and third Fed. And why do we have the third Fed? Right.
Well, you can say we had three Feds. We actually had three central banks, but one of them was called the Fed because they didn't want people to know. But there was a reason for that, Robert. You make a good point, because they didn't want people to know it was a central bank. Yes, the Fed is our third try. So the first Bank of the United States, I think it was kind of 1797 to 1816. It had a 20-year charter, so it went from the late 1790s to around 1814, give or take. And then they shut it down. They said, well, we don't need this. This is concentrating all the, it was actually based in Philadelphia, concentrated too much power in Philadelphia, the Eastern merchants and all that. So they let the charter expire. Well, then we got, then it was kind of a hangover from the War of 1812, and we needed finance, and trade was disrupted, et cetera. So I guess the first bank ended around 1812, but then after the war, we needed a new one. So they chartered a new one in 1816, and that was called the Second Bank of the United States, also a central bank on, I think, Chestnut Street in Philadelphia. The building's still there. It's a beautiful old building. Now, that was a 20-year charter also, so it ran until 1836. Well, guess who was president in 1836? Andrew Jackson. and he hated the central banks. And he came from Tennessee. He campaigned to shut down the central banks. Well, it was one of the biggest, fights in history with the Congress reauthorized it or not. He vetoed it. And so the second bank in the United States ended in 1836. So 2 tries, 2 failures. We had no central bank from 1836 to 1913. There was no central bank. And that was one of the, as you point out, Robert, one of the greatest periods of prosperity in American history. I mean, the telegraph, the telephone, the electricity, the automobile, I guess the airplane kind of came along at the tail end of that. Harvesters, machinery, ocean shipping, steam, you name railroads, you name it. I mean, we just grew and grew and grew from coast to coast, massively productive. Inflation was not a problem. Actually, deflation was a problem, but it was kind of the good kind of deflation where, when prices go down, if you make the same amount of money, you get a raise. You can buy more for your money. What's wrong with that when you think about it? So, and there were, you get guys who just sort of lost their way, like Paul Krugman said, but look at all the financial panics during the gold standard. It's like, I could list them, 1893, 1898, there were a lot of financial panics. By the way, look at all the financial panics without the gold standard. 1990, we had a serious recession. 1987, the stock market fell 22% one day. 1998, we came within an hour or so of shutting down every market in the world, and the LTCM crisis. 2000, the NASDAQ lost 80% after the dot-com bubble blew up. 2008, after Lehman bankruptcy, again, the world was hanging by a thread. 2020, the economy, stock market collapsed, 30% in about 1 month, and there are many other crises, the tequila crisis, 1994, et cetera, et cetera. The point is, there are financial crises on a gold standard. There are financial crises when you're not on a gold standard. Guess what that tells me? As a statistician, you would say there's no correlation between gold and financial crises. Financial crises happen, but they don't happen because of gold, and otherwise gold works fine. So that's something you can dismiss. So there were those crises, but the turning point, the U.S. economy was doing just fine without a central bank. National banks could issue dollars. The dollars were redeemable for gold, about $20 an ounce. If you had a $20 bill, you could walk into the bank and say, give me an ounce of gold, and they would. Or some equivalent of silver, it would be 20 ounces of silver at the time. That was the definition of a dollar. It was 1 ounce of pure silver. That was a dollar. So why 1913? Why all of a sudden did we want to bring back the central bank? Well, it goes back to the San Francisco earthquake in 1906. Devastating, of course. And so what happened was there were insurance claims. Everyone's building got, wiped out, knocked down, or burned out because it was huge fires, put in insurance claims. So the insurance companies had to sell assets in the Eastern markets. They had to sell stocks and bonds to get the cash to pay the claims in San Francisco. That created financial pressure in New York. And then throw in a couple of frauds. There was a panic with the Knickerbocker Trust. It was financing a corner of the copper market that blew up. Corners usually do. Anyway, there was a financial panic and there was no central bank. So what happened? Pierpont Morgan, everyone turned to Pierpont Morgan, the original JP Morgan. And he got all the bankers in his townhouse in Murray Hill around 35th Street and Madison Avenue in Manhattan. And he sent actually Benjamin Strong, who later became president of the Federal Reserve Bank of New York, out to audit all the banks in New York. And they did triage. And they broke the banks into 3 categories. They said, okay, you're strong enough to weather the storm. You're okay. This category, you're broke, you're insolvent, you're hopeless, we're going to let you go. And there was a middle category where they were not insolvent, but they were illiquid. So what they said is, okay, the strong banks lend money to these banks. That'll prop them up. We'll keep them open, and these guys will let them fall off a cliff. And they locked the bankers. He had his servants bolt the doors. So the bank, and then made us stay up all night. He bolted in like, so you're not getting out until you come up with an answer. And they stayed up all night. He knocked on the door and they said, we got an answer. And they came out and they did exactly what I just described. Well, it worked and the panic was over and the banks survived, but they didn't mind shutting down banks in those days. They don't anymore, but there were a large number of banks, a large number of depositors lost money, but they said, well, let's be more careful about your bank next time. But what happened was, Pierpont Morgan died not long after that, and the bankers, the Rockefeller interests, the Stillmans, the Morgan interests, said, well, this is going to happen again because bankers are dopes and they do it every 10 years like clockwork. And we're not going to have Pierpont Morgan around the next time. So there's nobody like him. So we need a central bank. We need a printing press, basically. And they cooked up the idea for what became the Federal Reserve. But they knew that Americans hated central banks, and they do. They still do. So they said, well, don't call it a central bank. Call it the Federal Reserve. It sounds like a brand of whiskey, It's like aged Federal Reserve. But they call it the Federal Reserve and have a board of governors and break it into 12 regions so it doesn't look too ominous. And they did all these gimmicks to basically make it not look like a central bank, even though it was. And the original purpose of the central bank, it really only had one purpose: lender of last resort. So next time there's a panic, like the panic of 1907, your job is to lend to illiquid institutions, not insolvent institutions, illiquid institutions. And Walter Bagehot, 19th century writer, sort of had written the playbook for central banking in the mid 19th century. And he said a central bank in a financial crisis should do three things: lend freely to solvent institutions at a punitive rate. Turn the money spigot on, crank up the printing press, lend freely, but only to people who are solvent. Do not lend to the insolvent; let them fall by the wayside. And a punitive rate to teach them a lesson. Okay. Now, what did Ben Bernanke do in 2007? Well, he lent freely. We know that, to increase the balance sheet by $4 trillion. But to solvent and insolvent alike, they lent to everybody. AIG wasn't solvent. Half the banks on Wall Street weren't solvent, but they lent to them anyway. So they didn't follow Bagehot's number 2 rule. They lent to insolvent institutions, and it was not a punitive rate. It was close to zero. So Bernanke broke 2 of the 3 rules. He lent freely, but he lent to everybody, wasn't selective, and he lent at a zero rate. Well, that just means that, you got through it, but you just propped up a bunch of insolvent institutions and set them up for the next time. And, 2020 was different. 2020 was an economic crash. It was not a financial crisis. We did not have a financial crisis in 2020. We probably will the next time. But so the point is, we have a central bank for all the wrong reasons, but the real problem is that in 1934, during the Roosevelt administration, they reneged on the original Fed deal. They pulled all the power from the regions and put it back in Washington, where it is today. And then in the 1970s, I think 1979 or thereabouts, in the Humphrey Hawkins bill, they expanded the mandate of the central bank. It was no longer just price stability, which it always had been. Well, the stated mission was price stability. The real mission is bail out the banks. That's what you're there for. The stated mission was price stability. Okay, we don't want too much inflation. But they added a third mission, which was full employment. Well, mission 2 and 3 are inconsistent. A lot of times what you need to do to get price stability doesn't necessarily give you full employment, and vice versa. Full employment might mean inflation, which is inconsistent with goal number 2. So we've given, and now that, by the way, now the central bank, the Fed has a 4th mission, which is climate change. And that's another, we can spend a couple hours on that, Robert. We don't have to, but they're going to basically go back. They can't let Exxon, So
it's like I said, Jim, behind your back, we all call you the fire hose because you can't, I don't know how you do it for all that information.
I'll wrap up. Here's what I'll do with central banks. That the Fed is, I'll say, always wrong. I do a lot of economic forecasting, have models, but one of the best factors is if the Fed has a forecast, it's wrong. If you assume the opposite or certainly significantly reduced, you'll probably be very close to a strong prediction. And I got nervous last summer because, as I just explained earlier, Robert and Kim, I'm expecting disinflation, not strong inflation.
Right.
But the Fed was saying the same thing. They were saying inflation is transitory. And I got nervous because I said, wait a second, I'm agreeing with the Fed. What am I missing? Because I know they're always wrong. And I was like, if I agree with them, I must be missing something. But fortunately for me, Powell flipped. He said, well, it's not transitory. Inflation is a real problem. So I feel much better because I feel that my forecast will be valid because the Fed finally disagrees with me.